All right. Okay, great. Let's see if let me get the chat going here. Okay. We are we live? Yeah, we're live. Okay, great. So we have people are coming in. And okay, so Giovanni, do you want to do the introduction to Michael Howell, and then we can go from there?
Yeah. Hi everybody. Good morning. And so we have this very special guest, Michael Howell. Um, I got to know him by going deeper in the idea of liquidity because I wanted to know more about the interaction between Bitcoin and global liquidity. I made a model. I don't know, Michael, if you look at my model, but that's the main idea is I wanted to see how they interact with each other, and it's not a simple power law like the power law we find in Bitcoin, but it's there is some relationship, but it's
for sure
clearly there. And then I started to look for oscillations, like one of the things that I do, and then people started to tell me about you, and then I by looking a little bit about your work, I thought, okay, this is the person with I would like to interact because it seems that you understand also these kind of ideas of patterns and regularities. And I was very surprised by your 56-month cycles that seem so regular. Then I contacted you. In fact, at a certain point, I would like you to tell me, because it was kind of an intriguing answer. When I contacted you, you told me, if you can show me that Bitcoin is a power law, I will glad come to your show. So I would like you to elaborate on that, what you meant with that at a certain point whenever you have a chance.
Sure. Okay. Good. Okay. Well, what do you want me to say a little bit about what
yourself?
we do
Yes.
Capital?
Yes, absolutely. Yeah, if you can tell us more
Okay,
about yourself. And
basically, the genesis of what we do goes back several decades to when I worked for the American investment bank Salomon Brothers. And Salomon Brothers was the sort of, it was the bond markets and pretty much the Forex markets. It was a giant trading operation that is now part of Citigroup. But it basically was a firm that sort of started trading its own capital by trying to understand how markets work. And one of the key things in terms of understanding financial markets was, first of all, understanding how the fixed income markets work, because they're a critical component of that. And the other thing was to understand flow of funds. And Henry Kaufman, who was head of research, is sort of the doyen of flow of funds accounting. And a lot of the stuff he wrote was really trying to understand the backdrop for why interest rates are moving, why financial markets are shifting around, why capital is winging its way around the world. And so basically across border, what we do in sort of further iterations is to understand that money flow and capital flow from a global perspective. So we supply institutional investors worldwide with data and narrative in the operations of central banks in about 90 countries and the movements of capital flows around the world. So we construct a series of indexes, which are called the GLI or Global Liquidity Indexes, and the name is a clue. And what they try and do is to understand the cyclical movement of liquidity through world financial markets. And it's really as straightforward as that. And a quick heads up to maybe interpreting those. We can split those in terms of different ways: what central banks are doing, what cross-border investors are doing, what private institutions are doing in terms of liquidity creation. We can split it by country. And at the end of the day, the sort of quick heads up is the most important central bank for financial markets is clearly the US Federal Reserve. And the most important central bank for understanding the real economy is really the People's Bank of China. One drives financial asset markets, the other tends to drive commodity markets.
China drives commodity.
Yeah, increasingly, yeah.
Michael, just as an aside, I was at Salomon Brothers also from from 1986 to 1989, and
we overlapped in that case.
Yeah. You were in London, right?
I
Presumably.
was in London. Yeah, I spent quite a while in the US too, but
Did
I worked in Bob Solomon's group.
you know David Weil in London and Kostas Kaplanis?
Oh yeah, Costas. Yep.
Yeah. Yeah, they're very good friends of mine. And
Okay. Interesting.
I visited the London a couple times. I was in New York, but yeah.
Right.
Yeah. Okay. We also have Stephen Perrinode, astrophysicist from Harvard, and the person who drove me to Giovanni and the Power Law. And we have Sina, also great quantitative research. So all of us are Bitcoiners, Michael. I'm curious where your research has taken you in Bitcoin. We can talk about liquidity in general, but I'm just very curious if you're kind of what your journey has been on the Bitcoin side.
Yeah, well, I think the answer is that it's really been an empirical association of trying to find monetary inflation hedges, and I'll go into what I mean by that in a moment. Traditionally, it's gold or precious metals, which has been the proven monetary inflation hedge over the long term. But it seems to be increasingly the case that Bitcoin is acting like digital gold, and what you see is what you get, and it's proved to be a pretty remarkable monetary inflation hedge over the last 5 years. Whenever you see liquidity conditions expanding, Bitcoin tends to move roughly about 6 weeks after you see the first indications of liquidity changing direction. So that's really the sort of the journey. And what it comes down to is really understanding why you get cycles in liquidity, which I can go into. But that's broadly speaking the essence of my if you like, journey in Bitcoin so far.
And do you own personally any Bitcoin or for your clients?
Yes, I mean the answer is, for our clients we can't invest in Bitcoin, but personally, yes.
Okay. Well, I'll let Giovanni maybe start the discussion on liquidity, and Giovanni's done some research on that. I'm curious.
So with Bitcoin, we see we have this natural cycle that is its internal cycle, right? Of due to the halving, that is the 4-year cycle, the 48 months. But you identify this 56 month cycle, right?
65.
55, sorry.
65.
Do you know 65, correct? Sorry. Yeah, I just woke up. For me, it's very early. I am a howl. I woke up for you 9 o'clock, so early. But so 65, correct. Now, can you tell us what is your idea where this 65 comes from, and in general, why cycles? Why they are so regular? Because you will expect to be much more chaotic, right? Of course, money is moving from one place to another. There are particular reasons for it, but why the cycles? Why they are so precise?
Okay. Great question. Let me try and have a stab at that. Basically, what you've got if you pick up an economics textbook is a view of the world which is very archaic, very out of date. And what it says is that economies are driven by capital spending, and capital spending is attenuated by interest rates. In other words, financial markets act as capital raising mechanisms for capex spending, and that capex spending is the driver of economies. And therefore, given the fact that the depreciation cycle of capital goods is about 9 to 10 years, that's why a lot of economists come down to the view that you're looking at a 9 to 10 year economic cycle. That's the basic business cycle view. Now, my view is that that's wrong, and it's wrong because things have moved on. And if you go back 50 years, let's say, to the 1970s, during that decade, which was fairly representative, out of every 3 transactions in financial markets, 2 out of every 3 of those transactions was a capital raising transaction. So in other words, it was raising money for new capital expenditure. So that was the textbook model. Today, if you look at financial markets, 4 out of every 5 transactions are refinancing transactions of existing debts, and only 1 out of 5 is a new financing transaction. So in other words, financial markets today are no longer new capital raising mechanisms, they're debt refinancing mechanisms. Now, if you look at the stock of debt worldwide, which is eye-wateringly large, you've got something like $350 trillion of debt sitting on our backs in the world economy. And the average maturity of that debt or duration of that debt is about 5 years, which means that simple math says you've got to refinance on average $70 trillion of debt every year. Now, that's a huge ask for the financial system. And it doesn't matter about interest rates. What matters is the capacity of the financial system. In other words, the liquidity base of the financial system to roll that debt over. And that's really the essence of this view. So in other words, the 65-month cycle pretty much aligns with the frequency of the debt refinancing cycle. Now, there will be differences there because you can get, it's true that on average, 70 trillion is refinanced every year, but in some years it might be 60, and in other years it may be 80, and some years it may be 90. So you've clearly got a change there. But broadly speaking, that explains why the cycle is moving. Now, what's driving that cycle is increasingly the public sector, because the public sector's creation of debt is just becoming eye-wateringly large. And to give you a sort of heads up, for example, US public debt outstanding has increased 8-fold since year 2000. Interestingly, the dominant monetary inflation hedge, which is gold, has increased over that same time frame by about 8.5 times. So gold has matched. Very, very few other assets have got anywhere near that. And so what's happening is the whole financial system is basically creating liquidity to finance debt, or to help roll over debt, I should say, not to refinance debt. And that process is creating over time an increasing trend of monetization and liquidity. And that's why you need in portfolios monetary inflation hedges like gold, and I would argue probably Bitcoin.
Mm-hmm. And what do you think happens? Have you had and the other people will have other questions, but one of the things that interests me is how these two cycles, right, the internal Bitcoin cycle and this 65-month cycle interact. Have you looked at all how this interaction goes? Because they are slightly different, right? And so they don't perfectly synchronize. What happens when you have let's say two, and are you aware of any other situations like that where there are two slightly different cycles that interact with each other in terms of these liquidity movements?
Yeah, I mean, there are cycles. When you get interactions of cycles, you can get obviously complex results. And one of the things in business cycle theory is looking at the Kondratiev cycle with a kitchen cycle or whatever. And what you can get is when those cycles coincide, you get significant upswings and you get significant downswings in the cycles. So that's what we may look forward to. So if you've got a 4-year cycle in Bitcoin coinciding with a 5 to 6 year cycle in liquidity, when you get the peaks and the troughs, that coinciding, that's clearly a big event.
Mm-hmm. And by the way, I noticed that this year, this cycle, your 65-month cycle that they call the owl cycle, is going to peak more or less with the next Bitcoin cycle. So it's supposed to happen. That is supposed to happen around November 2025. Yours, correct me if I am wrong, around September of
yeah. I mean,
right? More or
yeah.
less.
I mean, I'll come quietly and say it could be November, but
yes.
I mean, the analysis is not quite that precise, but it's around late 2025 where it looks quite reasonable these cycles will coincide. So yeah, so that should be a significant period for Bitcoin over this period. So let's keep fingers crossed. But then you can see, look at what's happening in the gold market. I mean, the gold price is all-time highs, and people are scratching their head and saying, look, there's something anomalous here. Gold has broken away from real interest rates. It's going to come crashing down. This is just wrong. These things are responding to monetary inflation. It's as plain as that.
One, among Bitcoiners, and I think the 1,000 people that are listening right now are all pretty much Bitcoiners. There is a narrative that Bitcoin would have probably been at an all-time high right now if it was not for Mt. Gox and it was not for Germany selling and a bunch of extraneous sort of non-cyclical behavior. Do you buy that, and do you think that there's some reason that gold is sort of leading Bitcoin right now potentially to the upside?
Well, I think I think what you've said is very plausible. I'm not a Bitcoin analyst. I look at liquidity, so I'll accept what you say. But it seems a very plausible explanation. If you track liquidity and Bitcoin over time, what you tend to find, as I alluded to, is you get a multiplier of somewhere, in fact, a historic multiplier of about 4.5 times. So in other words, for every 10% expansion in liquidity, historically, and I stress this is historically, you've seen about a 45%, in other words, increase in Bitcoin prices with a lag of about 6 weeks. And that's what's tended to happen. Now, that 45% or 4.5 times multiplier is based on historic regression analysis, and it would not be true going forward. But in other words, of the same magnitude. But you are looking at a large number, and I don't know what that will be. Is it 2 times? Is it 2.5 times? Whatever it may be. Gold historically, over the very long term, has averaged a multiplier of about 1.5. So, in other words, for every 10% increase in liquidity, you're looking at a 15% increase in gold. And broadly speaking, we would suspect, looking at the dynamics of public sector debt and the need to increase liquidity to finance that, you're looking at 8 to 10% per annum increases in global liquidity. So these are the sort of magnitudes you're looking at. I would imagine 10 to 15% increases in gold prices per annum over the medium term. And if you said, what's Bitcoin going to do? Well, you're looking at probably bigger ones.
Why, in such a scenario, does one want to hold gold at all? Versus, is there any diversification benefit for holding? Is there any scenario in which gold really outperforms and Bitcoin doesn't in this liquidity cycle?
Well, I guess the answer to that would be there is some extraneous event that makes Bitcoin unattractive, and that could be legislation? I don't know, but I take your point. I mean, gold is one way to diversify, but maybe it's not a great diversifier because both are being driven by the same trend. I fully accept that. The only thing that I would fall back on in defense is to say that gold has a long-term track record which extends over centuries, whereas Bitcoin, we've got probably 5 years of decent data.
I'd love to bring in Stephen Perrineau because Stephen has done a little bit of analysis on Bitcoin versus gold. So maybe, Stephen, you could kind of chime in a little bit there.
Yes, pleasure to meet you, Michael.
Nice to meet you too.
Giovanni, of course, was the discoverer of the power law relationship between Bitcoin and essentially the US dollar. But it applies more broadly. It applies to any of the leading currencies. Could be the euro, could be the pound, the Swiss franc, the yen. It really doesn't matter. Certainly with the historical performance that we've had. I was probably the first to analyze it against gold, and we also see a power law there. And it's only slightly less. The power law index for Bitcoin versus the dollar is about 5.7, something close to the 6th power of the age of the asset. And with gold, it's above 5. It's around 5.2 or a bit higher. And it looks very much like the same sort of power law relationship and has equally good statistics, something like an R squared of 0.95. Just
do you have a graph, Stephen, so we can share it with Michael?
I can probably, I need to go find one and put it up.
Because I want to know what you think, Michael, about these relationships that we find. They're so regular.
Yeah, I think as I said at the beginning, I think they're very plausible. But I think, from an analyst's point of view, and that's what putting that hat on, I would argue what's driving them, what's the transmission process, and in my view, what's happening is that governments and central banks are devaluing paper money, and they're probably doing that well, I say deliberately, but they're doing that with the idea that they've got to maintain the stability or the integrity of the financial system. And the reason that, to go back and sort of explain that again, what you've got is a regularity in the world economy, which basically over time has shown that you need a fairly constant relationship or ratio between the amount of debt in the world and the amount of liquidity in the world. If you get liquidity, which is a shortfall versus debt, what you're going to get is refinancing crises in the world economy. And I would argue that if you look back over the last few decades, every financial crisis that you can cite is a refinancing crisis, a debt refinancing crisis in some form, whether it's 2008, whether it's the Asian financial crisis, whether it's the US repo crisis in 2019. All of these are examples of debt refinancing crises, and therefore you need liquidity. Now, the private sector has got a flaky track record of creating liquidity because it does until it doesn't. And then you get an implosion, and the central banks basically have to come in and start plowing in lots of liquidity. So the question is, number one, we know from experience that central banks will flood the system with liquidity when they need to. And the second thing is that the governments are creating debt as if it's going out of fashion. Because if you look at the math behind, looking at the US, which is probably the cleanest shirt in the laundry in many cases in the West, you've got mandatory spending there with Social Security and Medicare. You've got increased defense spending, and absolutely nobody of any of the parties or candidates in the presidential election are talking about increasing taxes. So you're going to have to kick the can down the road, which means more and more monetization. And that's exactly what the Treasury, Janet is doing at the Treasury right now.
But what I'm trying to understand from what you just said, in general, though, we see that all the other assets, right, respond to this increase in liquidity in an exponential fashion, because this is what liquidity does, right? But Bitcoin responds with this power law. And so it's actually very different from all the other assets, right? Do you have an intuition about that? Why?
Well, I would say it's really a question of scaling, isn't it? Because if you looked at NASDAQ, I think you'd find probably a similar-ish power law. And if you looked at the S&P, you would also find something similar, but it would be a lot watered down. It wouldn't be the same magnitude. And isn't this just saying that what you're looking at is, rather like a concept in finance called duration? If you've got a lot of liquidity in the system, you want to go to the longest duration asset. And it so happens that gold and Bitcoin are almost sort of infinite duration assets because they never pay back either the principal or a coupon.
I found the slide with the power law versus gold, and maybe Stephen could comment on this slide. Let me just bring it up here. You can kind of see it. There we go. So, Stephen, maybe you could just comment on this slide.
This one is 11 years of data. It's monthly data. I put both an exponential line and a power law line through this particular slide. The power law has a higher R squared, and if you look over a longer time frame, the power law clearly performs much better. And you can see it's about the fifth power of time here.
Mm-hmm.
Yeah. So, I think to kind of to the point that you're making about the duration, right? So is it just a duration thing? Well, yes and no, right? I definitely think it's beating all these other assets on a power law basis. So
yeah,
it is beating gold. Gold is going to zero relative to Bitcoin is basically the answer.
And if you don't mind, I want to show this graph where I compare SP 500 and Bitcoin on similar timescales. Because with Bitcoin, given we trade every day, you have to use almost 25 years of SP 500 data because the difference in trading days. So if we look at this graph, you can see that actually they are different, right? If you don't mind sharing this graph, Fred.
Yep. Hold on.
With the audience. You see, in a log scale, you will see Bitcoin like a straight line, and it looks a very, very precise straight line. We did all kind of testing to show, yeah, it does meet the criteria to be a power law. And you can see the behavior of SP500 is different, right? And here actually I plotted versus some consistent inflation rate. And again, it's curved up, right? It doesn't look like a straight line. So power law will look like straight line, while other assets usually don't look like straight line when you look at these similar time scales, like in this case 25, because it's basically the equivalent of 15 years of continuous trading 24/7. So it does behave in a different way. We think one of the reasons is because it does behave more like a social network than a normal asset. So it has network properties. In fact, we were able to show, for example, that the addresses, the growth of the addresses is also a power law. And if you use that as a proxy for adoption, and then Metcalfe law, because this is how Metcalfe said network are value, you go from the Metcalfe law, so there is basically a square relationship between addresses and price.
Can
and the
you
addresses
can you put the slide with the addresses, because it's just
yeah, I will. Let me find it for a second. Yes, well, actually this one. Yeah, this one. You see this one? So yeah, this is the first slide is addresses versus time, and you can try different fit. People say, try to fit it usually with an S curve, because they are thinking technological adoption that usually is described by this S curve. S curve is nothing else the integral of a Gaussian distribution, but the best fit is actually a power law with the power of 3 in time. And by the way, it turns out that many viruses spread exactly with the power law of 3, like AIDS, for example. Historically, it did that. So we are thinking it's almost like a virus of the mind. And then you have the relationship between the price and time that is very close to be 2. And when you combine these two, you get this power law in time that has close to 5.8. That is basically the combination of these two. So you have these two power laws, and there is a lot of literature that shows that if you are dealing with a social network, both the nodes, and in this case, you can think that the addresses are like nodes in a network because they represent, in a certain sense, the Bitcoiners. It's a proxy for adoption. And then because of the Metcalfe law, right, the number of node of connections, it's related to the price. And so if you look at Bitcoin from this lens, that is actually more like a social network than any other type of asset, then you see this beautiful power law, very, very kind of striking power law.
Yeah, I think this is another graph that shows the same result, Michael, which is if you look at just how many addresses have one Bitcoin in them, right? And you graph that over time, and you measure time in logarithm of the time since the Genesis block. It actually is an amazing graph, and you may not be able to see it perfectly on this screen, but if you look there, you'll see that it is a power of 1.4 over time, and the R squared is 98.7%. So it's very clear to me, at least, that the adoption of Bitcoin is relentless, and it almost doesn't depend on the markets, right? So it's going up regardless, and there's even a power law of a reverse power law between how many addresses have one Bitcoin, have 0.1 Bitcoin, have 0.01 Bitcoin, etc. So I think there is a narrative that we've uncovered that says the power law the adoption of Bitcoin as a savings technology is an asset class, is a power law, and this gives rise to this power law, which is really, more and more makes sense, right? Because it's sort of more and more people are realizing, that more and more people are realizing that this is a great technology to save their money and to keep it outside of the government. And as more and more people discover that, more and more people are buying Bitcoin, and the price of Bitcoin is going up as a power law. That's sort of I think that's the TLDR of kind of the research of this group, I would say.
Right. Very plausible. But then you'd have to argue that people outside of America should be buying Bitcoin in spades because they've got more reason to be defensive because their currencies look a lot flakier, particularly if you start to extend to emerging economies.
Right, they are right. They are buying it, to the cubed of time, right? So as you look at over the last 15 years, the number, what we believe is the number of users of Bitcoin, the number of people who are users at some level, maybe. And you can take another rate, which is how many people have $100 worth of Bitcoin, right? That number is growing like and so they are buying it in spades. They are getting it in spades. Now, why isn't it more exponential? Well, I think it's, people are spreading the virus, and Giovanni.
So I have an idea about that. So why, for example, AIDS, and I know that many Bitcoiners don't want to compare it with something bad like AIDS, but the idea is the mechanism behind, right? So basically the difference between a power law and an exponential is this. You have some kind of rate. In the case of Bitcoin, I made even an infographic where basically every day, it's an idealization, of course, because it's kind of an average over a certain amount of time. But every day, basically, you have 3 times more Bitcoiners relatively to the number of Bitcoiners right now. So it's an iteration process. So you take 3, you multiply by the number of Bitcoiners. We're talking about addresses, but in this simplification, I'm exchanging addresses with Bitcoiners. So 3 times the Bitcoiners. And if you stop there, if a story stops there, you will get exponential, right? Because you know very well that if you multiply something over and over again, you're going to get an exponential behavior. What happens, there is a time factor. So basically, the efficiency of the spreading of this virus goes down with the aging of a system. And it's almost like a curbing mechanism. It's the same thing that happened with AIDS, where when people got aware that there was this illness, that they started to take precaution, etc. And that slowed down the growth, they made it more consistent and more, let's say, scale invariant. So basically behaves a different scale in a proportional fashion. Because when you do this graph log versus log, you're seeing the scale, right? And so the fact that it's a straight line, it means it's proportional over time. Now, the idea is that, so what is the relationship with Bitcoin? Well, we call this process orange peeling, right? Because it's something that takes awareness. When you are offering somebody to be part of a network, people don't jump immediately. They need to learn about Bitcoin. There is some initial doubts, and people need to learn. It's a process that takes awareness, right? It doesn't happen overnight. It's not something that is obvious. I know by experience, and probably every Bitcoiner knows by experience, when you go and start to talk about Bitcoin to your friends, to your family, right? Because we kind of act almost like religious people that are trying to spread the news, the good news. It's not easy. So in a certain sense, actually, this the fact that it takes awareness, the fact that you have to think about it, that you need to understand what you're doing, it kind of slowing down the process. But it's good because then you have a very dedicated investors. Once you are orange peel, you stay with it. You don't treat it anymore like a normal asset. You are dedicated to it. You want to hold it over a very long period of time. We have this internal meme of hodling. I don't know if you're aware of it, right? HODL. It's a long time meme. So it's a different type of understanding. People don't buy a Bitcoin because it's just another asset. So, there is another attitude. Now, with the incoming of this institution, we will have to see, right? Because probably they don't have a kind of almost religious faith towards Bitcoin. So we will have to see how that changes. But our studies, like Fred was telling you, when you look at different amounts of balance in the wallet, they seem to behave basically the same in the end, right? So basically, as you make the balance, I have even a graph here that I can share with you if you don't mind, Fred, to share this graph. This is what he was trying to explain you. So in this graph, I took different cuts. I took wallets with 1 Bitcoin, 2 Bitcoins, 10 Bitcoins, and you see you have this in the upper panel. You see the growth of these different type of addresses. If you take large amounts, they grow very slowly, almost linearly. If you take everybody, it grows like a cube. And then the next panel shows the impact, how much impactful these wallets are. And the steeper line that you see there, they are all power laws. The steeper one is the large wallets. They have a huge impact, almost like a power of 5. That makes sense. These are what we call whales, right? They have big, huge impact. So these will be institutions, large corporations, and things like that. And the lower one is everybody, that is about a factor of, the power of 2. But you notice when you combine together, and these are the factors above, you always get these 5.6 something, because you basically take the product of these exponents, right? You take the product of the exponents, you get the same thing. And the last graph shows all these red lines that are basically models of Bitcoin created by this relationship. And you look at how they fall on top of each other. In other words, it doesn't matter if you are a small investor, a big investor, the final impact on the price over time is the same. So it's very interesting, again, scaling variant behavior of many.
So let me summarize this, Giovanni. I think what the point here is, what Michael was saying is that we have this global wave of liquidity flowing through all assets and lifting everything together. But at the same time, because Bitcoin is on its own adoption curve as well, it's being monetized. It's very tiny and it's finding its place compared to something like gold that's been there and for thousands of years and has reached its potential, now just growing in lockstep with liquidity. Bitcoin has that force behind it, plus its own rapid adoption pace through following the network process. But I want to hear a lot more from Michael about details of his work. I'm not sure when it's a good time to transition a little bit to some more questions about his model. I'll let Fred define that.
Why don't you lead off with a question if you want?
Sure. So, Michael, I have a few questions about your work, and I'll organize it into 2 buckets. First of all, I'd say I'm a business professor, also very interested in your work. I've been following it for the last couple of years. I think you have captured one of the most important metrics in the whole financial world. There's a lot of detail, but there is this big elephant in the room that not enough people are talking about. So great work there. But what I really want to understand is if because we have this general relationship between liquidity and assets, but I've also heard you go into further detail about the components that form, or essentially there might be a lot of things, but the big components in the liquidity bucket, I want to see if you've broken these down into specific buckets with different effects. So we are probably like thinking about different sources where liquidity comes from, and these sources might have different transmission mechanisms and different effects. Okay, so first question is, what are the big buckets where the liquidity comes from, and what's the transmission process? And the second question is, how is it the effect on financial assets different from these different buckets? So you already have done some great work in measuring the reaction of Bitcoin and gold and stock market to liquidity. Have you also looked at smaller sources of liquidity and how they affect different asset classes.
Yeah. Okay. Well, I mean, let me say first up that thanks for your kind words. I mean, I didn't discover liquidity. I think liquidity is a concept that I would really say was a Salomon Brothers concept. And what we've tried to do is make it just a little bit more tangible by trying to actually collect the data and supply that data and try and sort of fashion a narrative around what's happening. So that's pretty much what we do. To step back one step and to come back to a point that Giovanni was making, I would tend to think about this the move in Bitcoin as really having two moving parts. Let me think of it this way: as an intensive margin and an extensive margin. So number one is more people adopting, right? So you're looking at more and more people using Bitcoin, having their $100 in Bitcoin, and then an intensive margin where that $100 in institutions becomes 100, 1,000, 100,000, a million, or whatever it may be. Now, I would tend to think that the first of those, the extensive margin, is following maybe an S-curve adoption process or something akin to that. And the intensive margin is much more about protection against inflation or monetary inflation. So I think there are two factors which are driving the price of Bitcoin, which are coming together. And that maybe is why we're looking at the confluence of these cycles right now. And that may be a case. Now, to step back and to say about what we're collecting and how it impacts assets, we look at different slices of liquidity. So we tend to generally think about the financial system creating liquidity from, if you like, a primary base. And that primary base principally consists of what the central banks do in terms of liquidity generation, and also what collateral there is in the system for which private banking organizations or private credit facilities can actually create credit themselves. So if you like, there are two moving parts in this equation. And therefore, in terms of understanding the liquidity cycle, in our view, you've got to understand what the central banks are doing. And the second thing is you've got to understand what the private sector is doing. Now, we monitor what the private sectors are doing, but very generally it comes down to understanding the collateral pool. So that's things like US treasuries, the value of treasuries, the value of high quality assets that can be collateralized. And the other thing is then understanding the haircut that those collateral assets get for credit providers. Now, the size of that haircut tends to be very closely related to volatility in the markets, but particularly things like the MOVE index. So one of the things that we've been schooling a lot of our clients in is to say, look, you've got to look more and more at the MOVE index, measure of bond market volatility, to understand the liquidity cycle rather than the VIX index, which is the traditional measure of equity volatility. MOVE and bond markets are much, much more important in this whole equation. What we can do from that is then understand the dynamics of what central bank liquidity is doing, what private sector liquidity is doing, and within the private sector, we can identify cross-border movements of money. Now, if you then start to say, well, okay, what's really important in different areas, the research that we've done so far, and let's say, look, this is a big area, and we're just scratching the surface. Central bank liquidity, and this is something that I first discovered at Salomon Brothers way back in the late 1980s. Central bank liquidity tends to drive the slope of the term structure, and you can see yield curves basically moving within a few months of changes in central bank liquidity. In other words, if the Fed is easing and pumping in liquidity, the yield curve starts to steepen. Lo and behold, what are we seeing now? Exactly that phenomenon. In terms of what the private sector liquidity is doing, and private sector liquidity can be things like corporate cash flow, it can be things like bank or shadow bank lending or whatever, that tends to drive increasingly, or is increasingly obvious where it comes up, is in credit markets. Private credit markets tend to get a big lift from that. And then you look at cross-border flows, and cross-border flows tend to have their biggest impact on things like emerging markets. So if you're looking at cross-border flows of money into, let's say, Asia, that tends to be a big driver of Asian risk assets. So far, those are really the capsules or the compartments that we've managed to find. That's the sensitivities.
Now, do you give different weights to these contributions, and if so, how do you calculate these weights? They are based on.
Well, okay, to get into the weeds of this. There's a book that I wrote about 5 years ago, which is called Capital Wars, which happens to be the name of our Substack. And Capital Wars basically goes into detail of how these indexes are put together. Basically, we keep, if you like, 3 sets of data. We keep nominal dollar or Swiss franc or euro or yen denominations of liquidity. So we've got that database. And then we've got another database, which is what we call a flash database, where we basically gather data, but we never revise that data. So the first stab of the data is basically what you get in that database. It's a frozen database, and that's what quants want. And then the third iteration is then to create indexes out of those data pools. And we basically have various measures of liquidity, and we weight them together using largely through principal component analysis.
Okay, so it's actually based on some kind of cross validation of the data, and
correct,
and you extract the information directly from the data. You don't do it a priori. Okay, that is cool. This is why I loved your approach, because it's exactly what a quant will do. Like the more scientific way of doing it, instead of technical analysis or some other hand waving way of doing it. So I like it a lot.
So you're combining, say, a large number of variables into a single one, or you using the PCA, you divide it into several subcomponents?
Well, let me correct that. Basically, if you're looking at an individual country, to create a liquidity index, so we look at 2 ways, right? The first thing to say is that let's take the US. So for the US, we've got an aggregate, which is US liquidity in dollar terms. Now, in magnitude, that is going to be dominated probably still by shadow banks, right? Conventional banks will have a large slice of it. I'll give some spurious but convenient statistics. Let's say out of 100% pool of US liquidity, 50% is basically is shadow bank lending, 40% is bank lending, traditional bank lending, and 10% is what the Federal Reserve is lending. Okay. Now, what we know is actually the Federal Reserve is more important than any of those other elements. So we've got to try and work out some sort of weighting system. And what we do is we use principal component analysis to create an index of the intensity of US liquidity, right? And we do that for every country. Now, when we combine the indexes together into our global liquidity index, they are weighted together by the dollar share at a fixed point in time. So we basically have 10-year windows. So we had an index base at year 2000. We've just gone to year 2020 weightings, and then we'll do another one if I'm still around in 2040. But basically, that's how it works. And we had an original one for 1980 weights.
Very interesting.
Does that answer the question?
Yeah. So dimension reduction at the level of country, and then combining country level indexes.
Correct.
Very cool.
I'm curious, Michael. Dealing with Bitcoiners now. A lot of us Bitcoiners have very extreme longer term views, and I'm curious if you have any of those views. So those views being hyper-Bitcoinization, the end of fiat completely, and going to a world where things are priced in Bitcoin, and maybe there is a little bit of fiat. There are still some countries that are holding back, but do you see a world and the timeframes here that people are talking about are 2040 plus, right? 2040, 2050. Do you see us going to that world of hyper Bitcoinization where we no longer have the printing press? We no longer have this liquidity pump. Is that something that you sort of see in the long term, or do you sort of see that we're going to be in a fiat world for the next century?
Well, I think there's a difference here between stores of value and the creation of credit. Okay. And even in a world where Bitcoin was the ultimate store of value, you could still use Bitcoin as collateral to create credit. So I think there's two different arguments here. I think it's quite plausible that Bitcoin takes a bigger and bigger role as the sort of the main collateral in the financial system, because as we know, it's robust. And it's a little bit like saying, if you go back to the 19th century, the main source of collateral was basically gold. We're on a gold standard after all. It's not implausible to see that gold standard like thing reinvented around Bitcoin. I think that's quite plausible. Maybe that's effectively what the BRICS will end up doing, because they're trying to get off the dollar hook, and they're using gold at the moment and some other own paper currencies. But if those paper currencies themselves become questionable, they may themselves be linked to Bitcoin. So you can see a transition occurring here. I think the issue really comes down to, the speed of adoption or the speed of getting from A to B will really depend on how much the West undermined its own financial system. And that's really a gift of the West itself, insofar as how much they let government debt explode. And the reality is that, I can't stress enough, although it's very difficult to keep banging one's fist on the table, to say, look, we're in a very different world here. The world changed after 2008, and it definitively changed after the COVID crisis, because what you've seen is governments take on huge amounts of debt. If we looked at the world before 2008, if you got a financial crisis, taxes ultimately went up, or there was temporary funding through the bond markets. Now what's happened is that spending, US government spending is, if my memory serves me correctly, is 40% higher than it was before Bitcoin. These numbers are sort of out of sight, and nobody wants to rein it in. Now, as I say, the US is, in many cases, the cleanest shirt in the laundry, because a lot of other countries are in a far worse situation. Look at the state that France is getting herself into now. France is where Italy was 10 years ago. Okay, and people are just waking up to the fact that there are cracks in the system. What happened to Britain 2 years ago with the Liz Truss moment? The sovereign debt market sold off when you got an errant budgetary policy. These are dangerous things. Bond vigilantes are around there, and they're creating instability. So you need something which is a solid collateral, and I would argue that's either gold or perhaps, or probably, it's Bitcoin.
So what's your view moving forward in the next? So because the Fed has just started reducing the rates, and there is discussion whether this is a panic move because the economy is weak, but then there's this wave of liquidity that will be coming from the Fed. So there's liquidity coming. There's potential economic weakening in interacting with it. But in the next year or so, and then with the election as well, what do you see for the global liquidity and the effects of it on different asset classes, including Bitcoin?
Okay. Well, look, spoiler alert. Central banks are not really interested in inflation or in unemployment. Okay, what they're interested in is preserving the integrity of the sovereign bond markets. Evidence that, look at what happened in the British case with the Liz Truss budget 2 years ago. Look at the alacrity with which the Bank of England switched from QT to QE overnight. That tells you what their game is. They've got to preserve the integrity of the sovereign bond market. Ask yourself this question. Look at the agency mortgage market in the US, which is basically a sovereign bond backed by the US government. Why is the spread abnormally large against treasuries? Answer: that Janet is managing to push the yield down on the treasury market. There's surreptitious yield curve control because the US is starting to fund itself increasingly at the short end of the market. Number one is the bill finance has gone up to about 22% of total debt issuance. And Janet has very, very cleverly managed to reduce the average maturity of auctions by 1.2 years. In other words, the average maturity of coupons being sold at US Treasury auctions has fallen since 2022 by 1.2 years. That is a big number, as Fred, from Salomon days will attest. What they're doing is they're funding at the short end of the market. That, believe me, is what's called monetization. Because the banks are buying that. Something like 3/4 of the increase in US M2 this year has basically been buying government securities. That's monetization. They're monetizing the deficit. Milton Friedman, who unfortunately not here anymore, would be turning in his grave. But that's why the gold price is at an all-time high. That's why people are buying Bitcoin. Governments are doing this before our eyes, but they're obviously not fessing up to it. But that's why the Why did the Federal Reserve change the rules on the stress tests for banks in the middle of August? Okay, they're taking the pressure off. They realize that these things are becoming bigger and bigger issues.
So when inflation rears its head again, what happens in 2 years?
Well, I mean, the answer for it is we've got inflation. We may not have high street inflation, but high street inflation is not monetary inflation. What we've got is monetary inflation. And high street inflation is a complex cocktail between monetary inflation, devaluing paper money, and other things like oil prices, like cheap Chinese goods, like productivity, like technology, and whatever. All these things are thrown into the mix. And so for the last 2 decades, we've had very slow high street inflation courtesy of these factors, but monetary inflation has been running on in the background, which is why the gold price has been going up. Looking forward, what we're getting is a cocktail where you may not get the same impetus from cheap Chinese goods. You may have higher oil prices to deal with. You may get slower productivity gains, and therefore the monetary inflation is going to spill over into the high street rather more. But what we say to our clients is, look, we're not in the game of protecting you against high street inflation. I mean, you can do that through the tips market, which actually, by the way, is a pretty good vehicle anyway. What we're in the business of doing is trying to protect you against monetary inflation. And for that, you've got to buy gold and probably Bitcoin.
Yeah, I just a little word on the tips. A former colleague of Michael's and I, you might know him as well, Victor Hagani.
Yeah, Victor, yeah.
Yeah, Victor has written this book on where have all the billionaires, the missing billionaires. And in the book, one of his favorite asset classes is tips.
Great book, well worth looking at.
Yeah, definitely should look at it. Just a little plug for our friend Victor's book, The Missing Billionaires. And the premise of this book is, if you look at Cornelius Vanderbilt, right, was the richest guy in the United States, when he died. And you look at his, great grandchildren, there actually are no millionaires in that list, which is amazing that fortune just got completely dissipated over 180 years. But it evaporated, and and Victor did a great job, I think. But Stephen, do you have any further questions for our guest?
Well, I'm just interested in your take, Michael, on why liquidity is a superior metric to the growth measures and the inflation measures that we often hear other people talking about in the macro world. And what do you think is the outstanding reason for that? And then how do those differ in time scales as well? I mean, you've talked about your time scale, but are those slower moving processes, and why are they less important?
Well, I think why do we look at liquidity? Because liquidity is sort of, I think, the primary engine of what's driving all this. It's a reflection of the size of the monetary system or the financial system, and liquidity is number one a credit measure. So we're looking at the asset side of credit providers' balance sheets, and credit providers are no longer banks. If it was as simple as looking at banks, we'd look at M2, but M2 is an archaic definition, simply because banks are no longer the main sources of credit in either the US or particularly the US economy, and also in the world economy. So, I mean, they're probably responsible for maybe under 40% of total credit supply. Other organizations are important. So that's number one reason for looking at liquidity. And number two reason is that, as I tried to argue, high street inflation is not the same as monetary inflation. We can debate, long into the night whether CPI is a great measure of high street inflation. I mean, I must say that my personal inflation rate's a lot higher than 2%, and I'd venture that everybody else in the world is 2%. So these CPI numbers are probably fixed anyway. But at the end of the day, monetary inflation is a component of high street inflation. For the reasons I said, you've got other factors, other moving parts which are affecting that. But what is really driving the price of gold and the price of Bitcoin, I think, or certainly part of the driving Bitcoin, is this monetary inflation. They're monetary inflation hedges. And we have got a serious amount of monetary inflation to tackle in the next few years, because basically I think global liquidity is expanding at an 8 to 10% annual rate. and that compounds pretty quickly. You know, the stock of liquidity is doubling every 7 years. What that means is that if the stock of liquidity is doubling every 10 years, then what you've got is, every 7 years, then you've got a situation where gold is doubling every 7 years, where Bitcoin is more than doubling every 7 years, etc. And these are powerful dynamics.
So for every X amount of increase in liquidity, you've calculated the corresponding effect on Bitcoin and gold and other assets.
The multipliers are basically for historic. These are regression factors, so one's got to give a health or a wealth warning. The regression factors for gold is about 1.5. So for 100% increase in liquidity, you get 150% increase in gold. Okay. For historically, for Bitcoin, it has been 4.5. So for every 100% increase in liquidity, it's been a 450% rise in Bitcoin. Now that, as I say, includes a lot of adoption effects, so you can't extrapolate that going forward. But you know, it's a big figure. It's bigger than gold, probably.
I have one question from the audience, and then we're going to close it off. Alex Natur asked Michael, what is the relationship between the MOVE index and liquidity?
Okay, the answer being is that if you look at what's driving liquidity is central banks and the pool of collateral. So in other words, if I want to borrow now, I go to a credit provider, but I've got to post collateral, and that collateral is very frequently a US Treasury. Okay, now the credit provider will say, okay, well I'm gonna lend you I'll lend you money, but I'm going to take $100 of collateral and I'm going to haircut that by 5%. So I'm only going to lend you 95 against that 100 collateral. Okay. Now that haircut changes. And if you've got a lot of uncertainty about the future value of that treasury, so in other words, bond volatility, the MOVE index is high, that haircut might be 10%. So in other words, I only can borrow 90. Or if you've got a situation where bond volatility collapses, they may lend me 98 against 100 collateral. So it's the effect of the change in bond volatility, the MOVE index, on the haircut to the collateral. And that gives you an idea of the collateral multiplier in the system, if that makes sense. Now, what you've got going on at the moment is the MOVE index, which has been historically quite high. It's been well over 100. I tend to read the MOVE index as saying that 100 is akin to 10% bond volatility across the curve. The long run average for the MOVE is about 70, which is about 7% average volatility, bond volatility across the curve. It's been as high as 200. Okay, so 20% vol. That's a lights out event. When I was at Salomon Brothers, it always used to be the case that people figured that 150 on the MOVE index was sort of death of the bond markets, but we've sort of survived that. But these are big numbers. It's coming down now, which is good for liquidity, but it's coming down because the US Treasury is doing treasury buybacks. So they're buying what are called stale or off the run treasuries and replacing those by on the run, and frequently they're replacing them by shorter duration on the run.
Michael,
so
thank you. I want to just thank you very much for coming, and thanks Giovanni for putting this together, and thanks everybody, and thanks for the people in the audience. This will be available on YouTube and on X, and